Good morning, everybody. My name is Patrick Admoko, the Executive Secretary and Chief Executive of Association of Corporate Treasurers of Nigeria. On behalf of the Governing Council and members of the association, I wish to welcome you all to today's webinar being hosted by the ACTN on the 2020 Economic Review and outlook for 2021. As usual, we will request anybody that has questions to kindly type your question in the question and answer box so that your questions can be addressed during the question and answer session. Now, without much ado, I would want to invite the president of the association, Mr. Zil Akariwe, to kindly give us his opening remarks, and then we take it up from there.
Good morning, everybody. Thank you very much, Patrick. We're not going to take a lot of time, so I'm going to do this very quickly. And on behalf of the Governing Council and members of the ACTN, I wish to welcome everyone to this webinar on 2020 Economic Review and the outlook for 2021. I don't think there's anybody who's going to dispute the fact that 2020 has been, for lack of a better word, a very interesting year, not just for Nigeria, but for the world at large. We had significant shutdowns of production facilities. We had lockdown across several states and countries for at least 3 to 4 months. All of this had negative implications on investments, on demand of every commodity, and overall global and the country's economic growth. Nigeria has experienced 3 consecutive quarters of rising inflation. I think we've had at least 3 to 4 years of very shaky economic fundamentals. In the last year, 8 to 10 months, we've had serious dollar scarcity that stemmed largely from what we believe to be low oil prices. The National Bureau of Statistics showed that the GDP for Nigeria was in negative 3.6%. And for many people, that signified a second recession in 5 years. Personally, and this is just my personal opinion, I think this is the same recession that we never got out of, because we're putting way too much effort and concentrating on the GDP figure and not the fundamentals that drive the GDP figure. So despite rising inflation, despite rising unemployment, despite falling productivity, all the economic pressures we've had, we said we're out of the recession, but all the economic indicators show that we were still, if nothing else, the economy had slowed down to such an extent that it couldn't support the businesses in the economy. Now, on the heels of this decline, which is one of the worst we've had globally, owing to the pandemic and which led to the oil price shock, there's still expectations that the economy will emerge back to growth in 2021. This is as per GDP. I'm talking from a fundamentals of the economic perspective. I think we still need 2 or 3 years to recover. However, the outlook is still fragile, clouded by uncertainty regarding inflation, unemployment, the security challenges, and of course, the rising social tensions. But today, I'm not the economic expert. I think we're very glad to have Razia Khan, who's the guest speaker, to share her thoughts on the Nigerian economy for 2020 and what to expect for 2021. If you remember, Razia was at our webinar in July to review the Nigerian economy. At that time, the focus was on the impact of COVID on the economy. So Razia is a good friend of the house. And I think, in my opinion, and I've known Razia for at least 15 years, we call her the Central Bank Governor for Africa. So please take notes, and whatever questions you have, put them in the chat box. We're going to get her to answer as many as time will allow. So please welcome to today, and we hope you have a fruitful discussion, and welcome again to the webinar. Thank you very much.
Thank you, Mr. President. At this point,
Patrick, my name is Zil.
Mr. President, sir. Okay, Zil. Thank you, Zil. We appreciate your remarks. At this point, I would want to call on Mrs. Kudi Badmos. Kudi Badmos is an executive director and CFO of Internal PLC. She is also a member of the ACTN Governing Council. I wish to invite her to formally introduce our guest speaker for today. Thank you.
Thank you, Patrick. Good morning, everyone, and welcome to the ACTN webinar. Thank you for joining us. I have the honor of introducing to you a speaker of today, Razia Khan. As our president has mentioned, she is a friend of the house, so we are happy to have her here with us again. Razia is the head of research, Africa and Middle East for Standard Chartered Bank, a global bank that I bet we all have accounts with Standard Chartered Bank. With over 2 decades of experience covering emerging and frontier markets. So she is a specialist in our markets, as we all will hear from her today. She's a well-known commentator on the region and provides regular updates to central banks, finance ministries, sovereign wealth funds, other financial institutions and corporates in the region. She currently serves on the advisory board of the Royal Africa Society and is a trustee of Save the Children UK. Razia has previously served on the World Economic Forum's Global Future Council on migration and global agenda with focus on poverty and economic development. So we can't have a better person with us today. She's named one of the 100 most influential Africans in 2015 by New African Magazine and 100 Africa Economics Leaders by Institut Chazelle of Paris. So I welcome Razia into our midst today. Thank you very much for joining us. And over to you, Razia. Thank you.
Thank you very much. Good morning to everyone. It's wonderful to be amongst friends again. Sadly, I can't be physically in Lagos at this time, but I'm just counting the days and looking at all of the news around the vaccines to see when is it going to be possible to travel again. So what I have prepared for you is a brief updated presentation pack on the Nigerian economy. We know that there have been new developments in the FX sphere since then. Thank you very much, Patrick, for bringing that up. What I will do is try to go through this presentation and then we can open up for the question and answer session. So I very much look forward to a lively interactive session and to hear from you about how you're viewing current developments at this point in time. So moving on to, if we could go to slide 2 on the presentation pack. This is just a brief introduction on how we see things in Nigeria at the moment. We've titled the presentation, Nigeria Charting a Difficult Course. And I'll just go through some of the points that you'll see coming up on slide 2. That's the second page of this PDF. So despite the pressures of weak oil prices, Zeal, the president of your association, spoke earlier about his belief that maybe that initial recession had never really properly ended. What we'll go on to see is that Nigeria has made very little structural progress to date in terms of reducing its oil dependency. We know that Nigeria has been impacted around the time of the global financial crisis. Oil prices collapsed then, late 2014, the threat of shale oil. Once again, we were seeing significant pressures on oil prices into 2015, for which the Nigerian economy was very ill prepared for. And now with the COVID crisis. Why is this? Because oil has acted almost as a magnet for all of the negativity in markets around COVID. People stopped traveling, air traffic was significantly disrupted, oil demand saw its most significant plummeting in the history of oil markets in year-on-year terms as a result of COVID. And it wasn't until the news of the vaccine, coming soon after the US election results started to be more clear, that we saw oil markets getting much more of a bid. The rally in oil at the time really suggesting that the market, for the first time on the news of the vaccine, could look forward to a possible post-COVID future. Now, we know that there are going to be logistical issues in terms of how long it takes to roll out the vaccine. We know that there will be funding issues. You only need to look at schemes like COVAX to realize that it's not at all clear-cut how less developed economies will find the funding for the vaccine. But the news itself is positive, and what we're looking at this point in time is not just how does Nigeria ride the cyclical wave of recovery in oil prices, but will we see this effort towards securing the economic base of the country, moving away from the oil dependency that has characterized Nigeria for so many decades? Is this going to continue? Now, the reason why we say there's been little structural change is that, you know, oil's share of revenue came down in 2020. It was forced down because of what happened to oil prices and oil production, but the share of exports and GDP remained very little changed. Policy in 2021, and we have just published at Standard Chartered our 2021 Year Ahead publication, which looks at our expectations for the next year. We think that policy in Nigeria will continue to focus on long-term diversification. So accommodative monetary policy aimed at pressuring banks to boost their lending to the private sector, the so-called strategic sectors of the economy. But we've yet to see the impact of this fully in terms of how it allows for a more diversified economic base for the Nigerian economy. We also know that we are in a situation of very, very low interest rates in Nigeria. In fact, just last night, I was speaking on a credit panel to a US audience, and there were some who thought, well, Nigeria is the only country that has managed to move interest rates to such low levels. In a sense, this averts more significant debt difficulties. We all know that for the federal government, the debt service bill as a percentage of the revenue collected was very meaningful. So if you can move interest rates to these very low levels, surely that's a good thing. Surely that's something that boosts credit worthiness. We'll go on to look at this because, as is the case with what economists call financial repression everywhere, when interest rates are kept at artificially low levels in order to boost lending to the government, to make it cheaper for the government to borrow, or to boost lending to the private sector, there are consequences. There are real economy consequences, and these are the things that will need to be watched. We also know that some reform has been evident in Nigeria. The rate of VAT went up 2.5 percentage points this year. We know that fuel subsidy and power sector tariff reforms are underway. And in fact, it's our belief that given the prioritization of the fuel and power reforms in particular, given everything that is happening in the downstream sector in Nigeria, that perhaps FX stability will continue to be prized. That's just our read on the situation as it is now. Overall, we think that yes, there have been signs of reform, but maybe Nigeria still needs to act with greater urgency. Yes, oil prices are getting a lift. We saw the recent agreement, more OPEC plus, continuation of the production cuts, some sense that the earlier cuts will be tapered gradually. We'll see how things progress on a month-by-month basis. But if you're looking at some of the structural issues that the Nigerian economy has to contend with, if you look at the development challenges that Nigeria has to face, there's always the sense that you cannot possibly go too rapidly on reforms, that you have to make progress on a large number of different metrics, and the hope is that this will continue. So let's look now at the slide presentation, and if we move on to the next slide, which is oil dependency, how Nigeria has made very little structural progress. I hope you can see the slide properly. It's very easy. If you're on an iPad, you can just increase the size of it and hopefully the numbers come up clearly. But what this essentially shows you is oil exports, share of total exports in Nigeria. The light blue bar is where that was in 2012. The blue circle is where things were in 2018, and the green square is our expectation of where things will be ultimately for 2020. Oil's export, the share of oil exports in total exports, you'll see that even as late as 2012, by then shale had already started to be a feature in the US, and oil was still dominating the export profile. By 2020, the green square, it likely comes down to about 74.5%. But given what has happened to oil prices and oil production, that's not a very meaningful move at all. And the question we should all be asking is it a structural move? Or is it the case that when Nigeria's production quotas are eased slightly, when oil prices come back, oil's share of total exports is going to come right back up? The same thing with revenue. We know that 2020 has been a year of significant pressure. So the share of oil in total revenue, yes, that has come down very meaningfully. But again, is this a structural shift, or is it only a feature of where we are right now? Oil's share of real GDP, because Nigeria's economy is measured differently, we know that this is now in single digits. But keep an eye on these structural factors, because they will suggest to you just how much progress is being made or not being made in terms of moving the economy away from its oil dependency. If we go on to page 4 of this presentation, so the next page in the PDF, Nigeria's trend growth has declined. How much does it matter? For anyone aware of some of the socioeconomic constraints facing the Nigerian economy, for anyone with even passing reference to the country's population growth rate, you will know that this matters a great deal. We know that the easy years of growth, the years of reform, 2004 up until the global financial crisis, Nigeria was generally seeing much healthier rates of growth. It could also be that some of those growth numbers were the pre-rebasing GDP numbers. We just took the numbers from the IMF's World Economic Outlook database. Then came the global financial crisis, and the Nigerian economy never really recovered its momentum. There was a technical bounce in 2010, given the weakness that we had seen in 2009. But what you'll see very clearly there is that the years that followed all the way to 2014, yes, there was a gradual improvement, but it was nothing compared to the kind of growth that the Nigerian economy had seen in that pre-global financial crisis period. Then, of course, comes the late 2014 oil price collapse. This was the recession that Zeal was referring to earlier. And yes, the data do seem to bear him out in the suggestion that it has been very, very difficult for the Nigerian economy to recover from that initial oil price collapse. Now, we know that Nigeria hasn't been hit as badly as other economies. Over that time, 2015 to the current day, other oil-producing economies in Africa, take Angola, for example. Angola has not seen a single year of positive growth. Forget weekly positive growth. It's just been negative the whole time. Nigeria has been different. But every time I present these slides and this picture to Nigerian clients, the general sense I get is people are unimpressed. They say, look, unlike Angola, oil is such a small part of our economy. Nigeria is the most populous country in Africa. It should be doing so much better. There is so much more to the economy than oil. And what we know is, as a result of the COVID shock, we estimate a decline of 4.3% this year, a contraction, so a technical bounce in 2021. But with the extension of OPEC Plus production cuts, we think that oil sector growth in year-on-year terms will be negative, at least in the first half. Where we are expecting the lift to come from is from some of these very accommodative policies that have been put in place, the attempt to boost bank lending, the attempt to stop NPLs from rising to higher levels through the restructuring of loans, the directed credit to strategic sectors of the economy, we think that Nigeria's easy liquidity conditions will at least help. But the question is the 2.5% type growth that we expect from 2021 really going to be sufficient? From a per capita GDP perspective, we know, given Nigeria's population growth rate, that that's not good enough. And we also know, putting recent social issues in context, there is the sense that Nigeria has seen an entire lost decade of opportunity. Think back to the time when this was one of the most dynamic, promising, adopting reforms, changing rapidly economies in all of Africa. Nigeria can absolutely be that again. We think that the focus on reform will be important. There is nothing to suggest that higher growth rates are not within reach for the Nigerian economy. But it's easy to understand the sense of frustration, that sense of opportunities that were lost when we look at this chart. And indeed, it does bear out the thinking that there has been an entire lost decade of growth, a decade of lost opportunity for Nigeria in that sense. The question is, what structural reforms are now going to be put in place that make this different? So moving on to slide 5, we've written extensively about this. I spent much of my career researching, the typical conditions that oil-producing economies find themselves in and how to break out of that. And what has been very clear for a long time is that Nigeria's, I guess from the 1960s on, traditional model of growth, that here was the oil earnings and this is how it was allocated out in the rest of the economy, that's not nearly going to be enough. Development economists have written extensively about how Nigeria needs to move away from this old allocation model to a production model. It's not enough to rely just on oil earnings. Nigeria is bigger than that. Its population is bigger than that. There needs to be a much more comprehensive embrace of a production economy. Now, if we look to some of the production economies around the world that we've known a lot of, you only need to look at the example of East Asian countries. What typified them? We know that a lot of Nigeria's policy settings currently, take the foreign exchange policy, for example, that's at odds with what we've seen in economies that relied extensively on manufacturing to bring about development. Economies that said, we are properly going to be embracing this production model. So we see some reforms that are positive. Fuel subsidies, they needed to have been lifted years ago. It's a positive that that's finally being let go of. Power sector tariff reform, a move towards cost recovery in the power sector. Given the dire state of power availability in Nigeria, we know that this is a sector in urgent need of reform. And these are good, important steps forward. But we also sense that there's a great deal of conservatism in terms of looking through the policy settings in Nigeria. And the reality is that it's not really a choice for the government to be able to say, okay, free float of the Naira, because from now on, we're not going to be an allocation economy. We're going to be a production economy. We're just going to let market forces work and we'll see what happens. There are some economies that have adopted a different stance towards their exchange rate policy, preferring exchange rate undervaluation rather than overvaluation. And I think we all understand the socio-economic considerations in Nigeria where this really isn't realistically a choice for policymakers right now. But the question is, does the situation lend itself to that little bit more flexibility? Will we see Nigeria changing course over the coming year? Let's go on to see. Moving forward to page number 6 on the slide presentation, you'll excuse the analogy, but this is the economic dashboard. And we know that 2020, the COVID crisis, has been a year of incredible difficulty all round. Nigeria is not alone. It's very difficult to see any region in the world that has really escaped the impact of COVID. But what we do know is that some regions have been harder hit than other regions. And here's just a quick pictorial representation of where we are. Estimates of the fiscal balance being significantly higher as a percentage of GDP. We've used the IMF numbers there. Our own forecasts have come down slightly, and we think the difference is that debt service costs, especially local currency debt service costs, are just not going to be as elevated as we had initially feared. So we're looking at a smaller fiscal deficit than the IMF was when this slide pack was produced. The unemployment rate, we know that Nigeria has a significant problem of both unemployment and underemployment, problems that were worsened by the COVID containment measures. Real GDP growth, well, that's the Q2 number. That was the weakest point of the COVID crisis, but our full year expectation for 2020 is a contraction of just over 4% in GDP. And inflation, we're watching this with significant concern. For now, it's absolutely the case that the pressures on headline inflation are more supply side. There's very little evidence of a demand-led impact on inflation, but inflation is uncomfortably high. And this makes a difference to how good people are feeling. It is a policy issue. It is something that needs to be grappled with. If we move on to the next slide, I'd just like to highlight some of the excellent work that the Bureau of Statistics in Nigeria, NBS, has been doing in terms of highlighting the impact of COVID. And they've been running this longitudinal phone survey for a few months now, which really gives you a sense of just how hard people have been hit by the impact of COVID. So this slide pack was put together in November. Of course, in terms of the number of cases, we've moved on. Activity, we know that after those initial COVID containment measures, by September, we were seeing a stabilization in the share of survey respondents who reported that they were working again. But the overall numbers, 71% of that working age group, or what's loosely thought to be a working age demographic in developing countries, the 15-year-olds to the 64-year-olds, that number suggesting the numbers of people who are back working is below the pre-crisis levels that we were seeing. What's worse is there seems to have been a real gendered impact in terms of inequality, where the kind of, if you're monitoring who has lost their jobs in the formal sector, who's forced into becoming a trader because there just isn't anything else that they can do to keep their economic livelihoods going, there has been a real difference between the reported numbers amongst men compared to women. And what we are very concerned about, not just in Nigeria, but the world over, is the likelihood that what we do see after this crisis is very much a K-shaped recovery. And that is a recovery with worsening inequality that will have an impact, we think, on social stability considerations. The world over, you'll see policymakers talking about their concern around a K-shaped recovery. This essentially means that for people who are already comfortable, the kind of policy measures put in place, so those who have access to formal sector bank lending, that's where accommodative policy makes a difference. They're able to get bank loans, they might be able to bounce back. But for those who are cut out of formal economic structures, or even in developed economies, for those at the very lowest end of the income scale, who work in the services sector, whose livelihood depends on coming into face-to-face contact with others, there's a real concern that with a number of firms permanently going out of business, that their prospects are going to look very different, and it's a while before they recover. So when do look at some of the excellent work that has been done in terms of documenting the impact of COVID on the Nigerian economy, because that will tell you a great deal about what to expect in terms of the recovery and the health of that recovery. Moving on to slide 8, this is just looking at some of the key challenges that lie ahead. Rising inflation, weaker real disposable income, 27% unemployment, 29% underemployment is what we got from the survey data for Q2. And as a result of that, even with the best will in the world, even with fiscal spending being sustained at reasonably high levels, even with the authorities attempting to put in place really accommodative policy, the end result of this is that as a result of COVID, we are going to see weak consumption. Yes, policy helps. We are looking for a turnaround in H1 next year that will be more substantively led by Nigeria's non-oil economy. But we have to recognize the constraints that we're up against, and the data paints a fairly significant picture of just how difficult that is going to be. Moving to slide 9, this is a key consideration in terms of foreign exchange policy, which we will be talking a lot more about. This is what has changed for the Nigerian economy. For many years, with oil production levels being around 1.8 to 2 million barrels per day, oil prices being in a healthier range, Nigeria was running a current account surplus. The reality is that our own forecasts for the next 2 to 3 years or so see Nigeria running either a current account deficit or maybe just a current account balance in a best case scenario at the very end of that time horizon. And this is very meaningful in terms of what it suggests for policy. Because if a country is running a current account deficit, then let's not assume that organic accumulation of foreign exchange reserves is going to be that easy. If Nigeria sees a rise in its foreign exchange reserves, it will likely be on the back of external borrowing. It's not going to happen that easily, just in terms of the country's current account balance. If it's not in surplus, where are the reserves going to come from? And this raises very interesting questions about what needs to happen in terms of attracting foreign portfolio investment. Now let's take a step back here and think of the big picture that we see in the world today. There's a chart that I haven't included in this pack, but very happy to make that available to everyone, which shows the expansion in central bank balance sheet sizes of central banks around the world. And what we do know is that as a result of the COVID crisis, we are seeing more accommodative policy than we've seen in a long time around the world. Central banks have been printing money, have been keeping policy super accommodative. The Fed has started to talk about average inflation targeting. What all of this means is that policymakers are not looking to roll back the stimulus anytime soon. Now, this has also had an impact on financial markets. We're already seeing it in terms of Africa Eurobond spreads. Everyone is looking for higher yield. Investors are suddenly looking at this world awash with liquidity, improving prospects in emerging markets, expectations that we're going to see a weaker dollar on a multi-year basis over the coming years. And this is because the factors that have traditionally supported the dollar, higher yields than other developed markets, a better economic recovery trajectory than other developed markets, that's no longer the case. We think we are looking at a weaker dollar going forward. And so we are seeing new inflows into emerging markets. Take the South African rand, for example. At the peak of the COVID crisis, when the country had just lost its last investment grade rating around March, April, we saw dollar rand, which had been sub 14 at the start of the year, dollar rand rising to above 19 to the dollar. A massive, massive depreciation. And of course, policymakers in South Africa didn't try to fight that at all. I'm just reaching behind me to see my screen at the moment. Where are we right now? Well, the portfolio flows are starting to come back very gradually and on a selective basis. And dollar rand, it sold off a lot in the last trading session or so, but we were above 14, between 14 and 15 again, having been above 19 earlier. So the key point here is that as a result of all of the money being pumped out into the global economy, we are going to be seeing new flows into emerging markets. Nigeria's policy choices after the COVID crisis, initially the Naira was allowed to depreciate, There wasn't a huge issue with FX liquidity. We know that in the recent past, the CBN has stepped up its dollar sales on the I&E window, meeting the backlog for both portfolio investors and for corporates on the I&E window. And that's a positive. Needing to clear the backlog is likely to be a key demand for the World Bank, which will decide on budget support for Nigeria in mid-December. But we also know that many investors, local currency investors, are looking at Nigeria's situation and they're saying, well, first of all, yields are not at all compelling. You know, Nigeria did well for itself in driving interest rates down to these very low levels. It made servicing the budget deficit that much more affordable for the country, and there may have been good economic rationale for doing that. But for foreign investors, yields are not sufficiently compelling for them to re-enter Nigeria. But another key reason why they might hesitate, even if yields were to correct, would be the experience in the recent past of, once again, problems obtaining foreign exchange liquidity in Nigeria. While other emerging markets are likely to see far healthier yield-seeking inflows, for countries with more segmented foreign exchange markets, or where foreign portfolio investors will say, we don't know that we don't run the risk of having trapped funds in de facto terms in a country because we can't get the FX liquidity that we need on the exit, they might hesitate to come back too quickly. So this has been a fairly long story, but I want you to take two things away from this slide. One is that Nigeria is likely to be running a current account deficit in the near term, at least. This is going to make organic accumulation of foreign exchange reserves difficult. FX reserves will rise when Nigeria borrows externally, but not a lot of that is going to come from foreign portfolio investment into local currency debt, because the conditions that might support those inflows are not necessarily in place in Nigeria just yet. And we think this will be important to policy settings. Moving on to slide 10, and I'll go a little bit more quickly now to save us time for the Q&A session. You can see there what has happened to gross reserves. There was an injection from the emergency financing received from the IMF, and since then reserves haven't fallen further, despite, a great deal more. Yes, they've come down a bit from where they were, but they've been fairly stable. The big question is, how much has external borrowing already held up that level of foreign exchange reserves as reported in Nigeria? So moving to slide 11, you can see the difference there between what has happened to the oil price and what has happened to foreign exchange reserves. You can also see, with the benefit of the relationship through the years, traditionally there's been a close relationship. It may not be a direct relationship. It may be that when oil prices look to be stronger, the portfolio investment comes into Nigeria and foreign exchange reserves have held up well. But more recently, everyone would be looking to what happened in 2020 and to say, how long is that situation going to hold up? Thankfully, Nigeria does have the capacity to borrow more externally, but is this the right choice for the economy necessarily? If we move on to the next slide, slide 12, and a lot of these are for illustration only. So slide 12 will show us that despite reform, we know that the COVID crisis has taken its toll on revenue. You've got oil revenue and non-oil revenue there, and we don't yet have the 2020 numbers on this chart. But what's interesting to note is that from a very, very low base, look at the non-oil revenue bars. This is measured in trillions of naira, so yes, subject to the depreciation of the FX rate that we've also seen. But from a very low base, there has actually been an improvement in the amount of non-oil revenue collected. The problem is, in the very near term, 2020 COVID crisis, both oil and non-oil revenue mobilization are going to be hit back. Moving on to page 13 of this slide presentation, Nigeria, COVID-19 and weaker oil price push public debt higher. And this is the big concern. Across the Africa region, with Kenya looking likely to reach a 70% of GDP public debt ratio by the middle of next year, Ghana already reporting that as of the end of this year, it will have a 71% of GDP public debt ratio. The big concern is how much are these rising levels of debt, and you can see the dark blue chart there, which is the amount of debt levels that Nigeria has. It's still very modest compared to regional peers. But we also know that it doesn't take very much. Once a country gets to levels of around 40% of GDP, Nigeria isn't there yet. It's still in the low 30s, according to our estimate, or will just have gone over the 30% of GDP mark. But it's very difficult to stop that public debt accumulating even faster. So one of Nigeria's strengths is that from a credit investor perspective, it has what they call a clean balance sheet. Its public debt to GDP ratio is pretty low. But we shouldn't forget that Nigeria also has considerable development issues. And the question is, if it's going to be reliant on more external borrowing in the years ahead in order to stabilize foreign exchange reserves, what does that do to that public debt ratio? What does it mean for fiscal flexibility in Nigeria? Moving on to slide 14, and there are too many numbers to go into in great detail. But here are the budget assumptions as received from the Ministry of Finance. And, you know, when you've got the time, you could take a look at these in much closer detail. If we move on to slide 15, you'll see that one key problematic area here is just the amount of debt service as a percentage of revenue. Now, you could say, well, interest rates in Nigeria are as low as they're ever going to be. You know, it's been more successful than any other African country in terms of driving interest rates to these very low levels to help contain that debt service to revenue ratio. But you'll see that even as Nigeria recovers, and inevitably interest rates are going to have to move off these very, very low levels, we're still going to see a debt service to revenue ratio for the federal government, and these are federal government figures, that will be at least 40% of GDP, if not more. And this already suggests that there's very little fiscal room for maneuver, that if you're looking at the recent experience of growth, what has happened with revenue mobilization so far, debt service as a percentage of revenue is still worryingly high for Nigeria. Moving on to slide 16, here's another issue that sits a little bit uncomfortably. So here we were looking at CBN claims on the federal government. Now, the federal government, the DMO and others do make the point that Nigeria does have a treasury single account. Maybe we shouldn't only be looking at the amount of federal government borrowing from the CBN, we should also be taking into account how much the federal government has on deposit with the CBN and netting off the numbers. And that is a very fair comment. But what is worrying, just from an immediate quick glance at this, is if you look at the amount of borrowing that there has been by the federal government from the CBN, making increased use of its overdraft, and these are not net numbers, so, you know, please do take that into account. These are just the gross numbers. The net numbers would give a slightly different picture, but it speaks to budget vulnerability. 5.84 trillion is the federal government's estimate of how much revenue is available in aggregate to the federal government from all revenue sources in 2020. And the suggestion is that the use of the overdraft at the CBN has been in excess of the total amount of revenue from all other sources available to the federal government. And that is something that should be of concern to any economist. Now, we know that Nigeria does have plans for this borrowing. The DMO and the CBN have been very clear about the discussions that are underway. They are looking to securitize this debt. Chances are there will be a new 30-year bond created securitizing the debt. It would be for about 10 trillion naira. So that will eventually be added to the country's debt load. The discussions underway right now, we believe, are about what interest rate would apply. And this is really interesting because given the current very low structure of interest rates in Nigeria, you can understand why it would make sense for the federal government to want to ensure that whatever interest rate it secures on this 10 trillion naira amount that it's looking to securitize if it's borrowing from the CBN, it's all being done perfectly transparency. You can understand why there is a need to ensure that that interest rate is as low as possible to safeguard the fiscal space that Nigeria has in the future. So moving on to slide 17, some of this will be very familiar to all of you. One of the reasons why we are that much more optimistic about the bounce back in 2021 is not just the fact that we've seen this steep contraction and therefore we'll see a technical bounce in 2021, but actually lending to the private sector is increasing. These are the numbers available from the CBN, and you can see that pretty nicely where claims on the private sector in year-on-year terms, that is going up. This means policy has at least been successful in terms of being able to provide a buffer for those who are able to secure borrowing. There is some expectation that this is going to be helping growth. But moving on to slide 18, the pressure that we see in Nigeria at the moment. We all know that inflation, headline inflation, has moved a lot higher, and there are concerns. How long can the CBN keep policy very accommodative, keep interest rates at these exceptionally low levels without stoking inflation? For the moment, the CBN says, look, there isn't demand-led pressure on inflation at all, and they're right. We know that the land border closures, and there's been talk that this is going to be turned around, that is a good thing. We know that supply bottlenecks associated with the COVID crisis have been the key reasons insecurity driving food inflation higher. And you also see very clearly that core inflation, while still high, is pretty well contained. So we don't read from this the fact that there is any pressure. The deficit is being monetized at the moment, but that is not the root cause of inflation. The velocity of money in Nigeria is likely to be fairly low. And given that the economy is contracting this year, yes, there is a need for accommodative policy. But the question we should all be asking is, when it comes to it, will the CBN have the tools to drain liquidity from the market in a way to safeguard price stability? When we start to see a threat to inflation, perhaps coming through from the demand side, how easy is it going to be for the CBN to reverse course with its monetary policy, and how painful will that be for participants in the market? So the asset managers, as the OMO bills mature that they have been holding, and they're no longer allowed to hold OMO bills, and so they buy Nigerian government bonds at these incredibly low yields. When is the correction going to happen? How painful is it going to be? How do they manage that risk? That brings us to the end of the formal slide presentation, and we know that there have been a number of new policies that have been put in place. Thank you, Patrick, for your help with this. I think we can now take the slides down, and it's good to see everyone's faces again. We know that in the last week, we've seen a slew of different developments. First of all, we've seen after the parallel market was trading at close to 500, reflecting the absence of FX liquidity, increased CBN sales on the INE window, meeting demand, the backlog from investors, meeting the backlog from corporates. This has had an impact. The parallel market rates have shown some appreciation. We know that the new circulars on diaspora remittances and domiciliary accounts are also encouraging steps in the right direction, helping to boost confidence in the workability of the system. That's important. A key question that we've been getting from different clients, given that the INE rate has adjusted, is this for real? Are we going to see very gradual adjustments going forward. And our expectation is that yes, we will probably see small steps in the direction of a higher dollar-naira rate on the INE window, but we're not expecting to see anything hugely significant just yet. So we recently revised, just last week, in fact, revised our dollar-naira forecasts. We probably see an adjustment of about 4 naira a quarter, very moderate, keeping things stable. And this is because we fundamentally believe that the authorities will safeguard other policy reforms which require a more stable foreign exchange rate, and they're only willing to go that fast on FX liberalization. So for the moment, there isn't any expectation necessarily that we are going to see a big bang dismantling of, or a big bang change in terms of what has been happening on the INE window. We forecast just a gradual, very, very slow, almost imperceptible move higher in dollar-naira. We do expect that the World Bank decision on funding for Nigeria, that's going to the board, we think, on December the 14th, so this coming Monday, that will likely be a positive decision for Nigeria. And this is because Nigeria has started to take meaningful steps towards clearing the backlog of FX demand, harmonization of the different FX rates. You can argue that there's been some action, the start of the power sector tariff reforms, and of course that intent to dismantle fuel subsidies entirely. But for as long as interest rates remain at these very low levels, we think Nigeria is not going to be trying hard to get the foreign portfolio investment back into its local currency debt market just yet. And we do expect eventually a move in the dollar-naira exchange rate to about 440, but this will only happen when there is appetite to allow domestic interest rates to correct to much higher levels. We think that the oil price consideration will be all important for this. So our forecast is just very, very gradual measures that slowly allow for very, very gradual corrections on the INE window, no big FX moves. By the end of 2021, maybe with oil prices looking healthier, and a lot will depend on how strong demand is, then Nigeria might have the confidence to move even faster on the FX rate, but avoiding any very significant large moves that would be considered to be destabilizing in the interim. So sorry, I've spoken for an awfully long time, but I hope that slide presentation was of use to your members, and the slides, of course, can be distributed in their PDF form to all of your membership. Very happy to take any questions that you might have. So to avoid going back and forth to the Q&A myself, I'm not sure how you want to do this. Do you want me to just look at the Q&A and address it, or will you put the questions through?
Okay, no, we have somebody who will anchor the questions, and then we take the questions maybe in batches or one by one as they come.
Fantastic. Thank you. Thank you for listening.
Thank you very much, Razia, for such a brilliant presentation. I would want to invite the CEO of Interchange Supplies Management Limited, Mr. Funsho Shobande, he will be anchoring the question and answer session. Mr. Shobande has been a corporate treasurer. He has been a very seasoned bank treasurer. He has also been a past president of the Financial Market Dealers Association, and he is a member of the Governing Council of ACTN. It is my pleasure to invite Mr. Shobande to kindly anchor the Q&A session, please.
Thank you very much, Patrick, and for the introduction. And a big thank you to Razia for honoring our request again to be our guest and to do such a brilliant job on the presentation of the outlook concerning the 2021 budget and the 2021 financial year for Nigeria. My job this morning is quite simple: to coordinate the Q&A session. And whilst I'm still waiting for more questions to be populated, I'll take the liberty of having the microphone to start off on a question which I found very interesting, and I'm sure Razia is expecting this one. She did say that there was going to be what is known as financial repression, and that financial repression comes with its consequences. Obviously, this is a difficult conundrum, which has to do with the fact that in the federal government's bid to keep the financing costs for deficit to a minimum, they've dropped the interest rates so low. But this, on the other hand, is going to have consequences on attracting FPI flows, with the unattractive yields in the market right now. And it's also, it also has, while it's helping to finance the deficit, how do we balance this with the attraction to the attracting FPI flows? Given the fact that lower yields represent a capital gain for the existing holders of our instrument, new buyers will also face massive losses if rates go higher. So what is the incentive then for new investments into the market?
Thank you. And those are really great questions. So I think when we looked at some of the budget numbers, it became very clear why it is so important to the federal government that it has cheaper sources of financing. And the way many would be looking at this is if the choice is for Nigeria to be loading up on dollar-denominated debt, the dollar debt serves a purpose in that it can help to stabilize foreign exchange reserves and create that little bit more confidence in the stability of the FX rate. That's important. But there's got to be a limit to how much you just keep on loading up the foreign borrowing. We know that Nigeria has been there in the past, and we all know how difficult it was for Nigeria to come out of those Paris Club negotiations when it eventually did, clearing its historic debt load. We also know what a burden it was on the fiscus when it was considered to be such a highly indebted country. So on the one hand, given the kind of crisis that we see with COVID, the economy contracting, the very real human cost where people have lost their jobs, they're not able to earn a livelihood, you can understand easily why fiscal policy needs to be accommodative, why monetary policy needs to be accommodative, where if there is scope to ease the financing of the budget deficit, why not do that until the point where it starts to look as though it could be a threat to inflation? And for the moment, we know that Nigeria is still experiencing recessionary conditions. There isn't a demand-led threat to inflation. So to answer the question that you posed, Funsho, the question is really about everyone understands why there is a need for Nigeria to put this policy in place right now. Speaking to the IMF ResRep recently, I was surprised where even the IMF were asking, well, what else do you expect Nigeria to be doing? This is the IMF, usually, the flag bearer for very conservative policy, almost sounding like, yes, we can understand why this is happening. But as you say, the real challenge comes about when we need to see a reversal of these policies. What does it mean for asset managers? Nigeria is possibly the only place where recently we've seen more flows into the equity markets, and it's not necessarily all driven by the expectation that growth is going to be so much better, and this is what's driving more inflows into equities. It's really that we might even be seeing safe haven flows into equities because nobody wants to be caught out with the capital losses when interest rates eventually do correct. Now, one very interesting development that we've seen in the recent past is, of course, this talk of the special T-bills. They've got a very short-term tenor, 3 months. That suggests to us that they're not being issued necessarily to attract foreign investors back into Nigeria. But this is going to be an instrument that allows the CBN to fine-tune liquidity in the domestic market. We also know that while this can't be discounted at the CBN window, it will count as a liquid asset nonetheless that contributes to the liquidity ratios of different financial institutions. And we'll have to see how this operates overall. But what we need to pay careful attention to is what other mechanisms are available to the CBN to begin to mop up the excess liquidity in a relatively painless way. On the question of what do asset managers do, you know, if you buy longer term debt in Nigeria at current yields and you know that inflation is 14%, possibly climbing 16% to 18% next year, we'll have to see what happens, then at what you've got this realization that yields are deeply negative in real terms. It's common sense to know that the correction will eventually come. And what can asset managers do to minimize the losses? I wish I had the answer to that question. I think I should be posing that question to your membership, because it's a discussion that we have with everyone. It is the question occupying, or one of the big questions occupying the entire financial sector in Nigeria right now. And we all understand why there is this need for very low interest rates at this point in time. But we also understand that unlike developed economies, where the struggle is to get some inflation, to generate some inflation, to stop the US from spilling into deflationary conditions because of the weakness of demand, Nigeria is different. Other developed markets have aging populations. Nigeria's got one of the youngest demographics in the world. Other developed economies may have a serious issue with deflation. Nigeria has a more serious issue with keeping its FX rate stable, and it's got an issue with inflation. Not yet driven by demand, but that correction is going to come. So policymakers will need to start looking at that toolkit and start thinking ahead about when the correction eventually comes, how do they make it as painless as possible for the different actors involved? The bad news, though, is that these interest rates can't last forever and the correction will come. So it's a question of minimizing the losses associated with the correction.
Definitely.
I'm very happy to hear views from you. If anybody would like to talk about, you know, I'm sure there's a lot of thinking going into this in Nigeria. So what is the recommendation? How do you safeguard against these losses?
Well, I think the comment that I hear people make most often is the fact that the low interest rate regime seems to have favored, you know, the financial sector, the banks in particular, in the sense that whilst the interest rate for deposits have come down so low, the corresponding adjustment in the rate at which they access credit hasn't come down as much. And some people have even gone a step further to say, if the federal government's expenses are in Naira and the CBN has been accruing a lot of Naira, why then would the federal government want to borrow in foreign currency where it has little control over what it earns, and you know, that sort of thing. So that's the kind of comment you find coming out of people at this point in time. There's so much Naira which has been sterilized or trapped in the central bank, and the expenses are Naira based. So you did say, and I know that this is true, you did say that Nigeria does have more headroom in terms of capacity for additional foreign debt, which is quite true when you consider our situation vis-a-vis the peers in the African continent. So how best do you think this can be addressed? You know, the whole issue about the Naira.
Thank you. Maybe I will come in there. I think for me, the line is cutting up a little bit, but sorry, Fincho?
Naira again.
Just to address this issue of the foreign borrowing and the ideal mix between external and local financing of the deficit. Now, we know that Nigeria has already, over the course of 2020, reached the 60-40 ratio that it's been talking about. When it was much more 80-20, there was a realization that Nigeria did have the room to borrow more externally. The question is, if there's a lot more borrowing and the overall amount of debt is rising, then Nigeria could still afford to borrow more externally, still keeping the ratio at around 60-40. It's not a binding constraint. But the more important metric that everyone should be looking at is perhaps, how is Nigeria doing with its generation of foreign exchange receipts from areas other than just oil exports? We know that especially when OPEC production quotas apply, and given that Nigeria is a price taker in global markets, it's not in control of how much oil receipts it can generate. So how much foreign borrowing would be sound and how much would be too much is really going to be a function on what is Nigeria doing with its non-oil export growth. Grow that base and you will be able to borrow in external markets with greater confidence. There's also an expectation that for any country that ever does borrow in external markets, there is going to be a need to come back frequently to the market to refinance that debt. So once you've seen a certain amount of Eurobond issuance, you'll always expect to see much more on the back of that. There is room for Nigeria to increase its external borrowing, but it should always be done in a phased way. And if concessional borrowing is available from multilateral sources, for example, better to exhaust those sources of concessional borrowing first that come at a much lower interest rate than to only seek exclusively external commercial borrowing.
Thank you, Razia. I did lose you there briefly. I don't know, there was a problem with the internet, but I did hear the latter part of that question. Now, I'd move on to another question, which is basically has to do with the fact that you did speak about the COVID crisis and its toll on revenues for Nigeria. Well, you know, the situation is one which has been, it's a global problem, and the size of the interventions regarding the pandemic appears to be somewhat proportional to the size of the expected, you know, recession or contraction in the various economies. I know the UK spent about 330 billion approximately. USA spent almost 3.2 trillion. And I think Nigeria has proposed to spend 6 trillion or thereabout, which is about 5% of its GDP. Now, in view of this, you did also speak about the K-shaped recovery, which implies that different parts of the economy will pick up at different paces, different times, and different sort of rates and different magnitudes. What's the likelihood that all this will happen in a coordinated effort to lift the economy from the minus 6.2% negative growth in Q2, you know, to where we need to be via projections for, you know, 2021 and beyond?
Thank you, Fensho. So a couple of comments on that question. The first part is in terms of the revenue deterioration that we've seen. The IMF earlier on in the crisis, and they're probably still updating this, there is a link available, has looked at the amount of pure COVID spending that has been made possible in different countries. So the COVID alleviation spending. And this, of course, is important to track, especially for those economies, not Nigeria for the moment, that have opted for the G20 debt service suspension initiative. Nigeria decided that it couldn't do that because, one, the amount of debt that would have fallen under scope of the DSSI probably wasn't worth it in light of the uncertainty that it would have caused. And maybe there were specific loan covenants that would have treated, you know, that would have allowed creditors to call in all the debt owed to them by Nigeria if Nigeria had opted for this debt service suspension initiative. But The point that I'm trying to make is that the IMF has had to start monitoring this very carefully, because the whole G20 DSSI, the argument was, we give you some time relief in terms of when you have to start repaying the debt, and the period of debt suspension is through to the middle of 2021. After that, there is a grace period of 1 year, and whatever debt would have been due prior to that, but was rescheduled, the debt service and the debt repayments, that is repaid gradually over a period of 5 years. So it does provide a little bit of breathing space for countries, especially those with a large amount of debt that was owed to official bilateral and multilateral creditors. However, this came with a very clear condition that whatever you spend on has to be COVID alleviation. You can't just say, hey, it would be nice not to pay our debts. You know, there was a very real reason for this scheme to come about. It's because of the very real pain that developing countries felt as their revenue base fell apart given the impact of the COVID crisis. Now, Nigeria hasn't been spared those revenue pressures. We saw this with the earlier slide in the presentation. There had been a nice, very gradual and from a very, very low base, but there had been an uplift in the amount of non-oil revenue in trillions of naira that was being collected in Nigeria over time. And that was good news, but the bad news is the COVID crisis would have knocked back oil revenue, and it would have knocked back non-oil revenue in a very meaningful way. So what we're seeing in Nigeria, alongside, I have to say, most of the African countries, if not every single one of the African countries that I personally cover, is that there hasn't been a massive amount of budgetary resource. I would be surprised if it even accounted for that 5% of GDP in terms of available spending for COVID alleviation. What we've seen in country after country is that the fiscal space has been hugely constrained, and the deficit widening really came about because of what happened to revenue. In very few instances did it actually come about from direct spending in response to the COVID crisis. The reality of the situation is that most economies in Africa have just not had the fiscal space to put in place a meaningful boost to spending. So here in the UK, as a developed market, deep and liquid debt markets, low inflation, the ability to turn on QE very quickly and to scale up that QE even further, the UK government has been able to introduce a furlough scheme for people who had lost their jobs and were formerly making income tax payments. They were able to get at least first 80% of the amount that they would have been paid while they've been furloughed, and that acts as an important buffer. The reality that we all need to acknowledge is that for the typical economy in Africa, there has been no such social safety net. There hasn't been the fiscal space to provide one. There hasn't been the capacity of government to scale up that social safety net by several percentage points of GDP. It just hasn't been in place. What fiscal deterioration did take place, which still adds to debt ratios over time because you've got a bigger fiscal deficit that needs to be financed, that came almost exclusively from the revenue deterioration. The amount of additional spending is a very small part of it.
Okay, thank you, Razia. I think the question I'm seeing now is, he has asked whether you could discuss briefly how Nigeria has applied, all the money it's been able to borrow, and how important it is for the assets funded from the borrowing to be able to fund their repayments. I think if I were to paraphrase this, I would say, I would tend to suggest that he's alluding to the fact that the Eurobond financing program, we're starting to see the maturities from January next year. How well poised are we to accommodate these repayments, given the current of reserves and the fact that initially I didn't think there were any sinking fund provisions for these maturities. But it does look like in the new budget, there is a provision for sinking fund, although that looks like it's with respect to the Naira borrowings.
Yes, so that is a very good question. And I wish I had an easy answer and could say it was exactly X, Y, and Z done with the proceeds of that first Eurobond issuance. I'm going to have to do a lot more work and write a lot more OTGs to be able, on the ground publications, to be able to answer that question. But maybe I can use the opportunity instead to make a quick plug for the Standard Chartered Research website. Contact your local SCB salespeople. If Elizabeth is, I know, part of your organization, get yourself access to the website and you'll be able to read these research reports as and when they're produced. But the honest answer that I have for show at this point in time is we'll have to do a lot more work to see how those proceeds have been used.
Thank you very much, Razia. There are one more question here, and this has to do with the fact that you did allude to the fact that the central bank appears to have been making efforts to clear the backlog in terms of the accumulated FX demand. But people have complained that the priority seems to be going towards the Form M transactions rather than the Form A. So there's still a significant backlog with regard to invisible remittances and that sort of thing. And with the growth risks from the growing debt exposure in terms of interest rate risk, foreign exchange risk, refinancing risks, and so on and so forth, the exchange rate risk exposure appears to be increasing in line with the rising level of external debt, which is currently estimated at about 30–35% of the total debt. So with the recourse to the Eurobond financing, which according to the statistics available, now accounts for about 55% of the external debt, how much pressure is enough pressure? Trying to balance the fact that we do have a clean balance sheet, but balancing that against our ability to generate revenues to offset that liability.
Thank you. That is an excellent question. And I think especially for your membership, corporate treasuries in Nigeria, there will have been a sense that, first of all, the backlog was accumulated over a substantial amount of time. Initially, when we started to see increasing CBN sales, it did appear as though foreign portfolio investment and the clearance of that backlog was being prioritized, and the sales to corporates would have come a lot later. On the I&E window, it's only very recently that we've seen the ramping up of those sales addressing the backlog from corporates that had been accumulated. And that's a very interesting observation on the prioritization of Form M type transactions rather than Form A type transactions. The concern around invisibles, we know that there's been a lot of other activity in the background to this. So the restructuring of commitments, loans from the parent company to the Nigerian subsidiary in some instances, different ways of trying to find a workaround for this. And we also know that this isn't the first time that we've seen this trend in Nigeria. If we look at that period from 2015 on, there was a great deal of this. It was a case of how do you deal with the obligations that have to be repaid when the Nigerian entity isn't able to source the foreign exchange itself. A hugely interesting part of this study should be the accumulated backlog in terms of the debt service payments and the debt repayments that now need to be made, perhaps to the parent entity, and just how large, an amount this accounts for. So you're absolutely right in that it seems with the greater frequency of these instances where foreign exchange availability is restricted, the liquidity just isn't there, Nigeria is taking on a greater and greater share of repayments that will have to eventually be made. And because these, tend not to be seen as goods related necessarily, they are invisibles related, it's nonetheless still an obligation that will have to be made. And so it goes back to the question, what is the easiest way of dealing with this? The hope is that when oil production is allowed to increase that much more, and we do see a lift to oil prices, although our forecast for 2021 at the moment is just an average of $44 a barrel, we should not forget that OPEC production cuts are playing a very substantial role in keeping oil prices supported where they currently are. And if the market senses that there is any waning of that commitment, that compliance on the part of OPEC members, especially to those production cuts, then we could see further downsides to the oil price. As much as oil prices rallied on the news of the vaccine, at the very same time, we were seeing the surge in infections, COVID infections in the US. The real economy news continues to be one of something that cuts into the demand for oil, even though markets are forward-looking and are thinking at some point we see a recovery. So what I'm trying to say, perhaps in a very long-winded way, is there isn't that much confidence in terms of oil prices even being able to keep current levels. Oil price stability, there's a lot of work that's going on behind the scenes to ensure that oil prices are supported here. But it isn't necessarily being driven by underlying demand for oil. And if we should see pressures re-emerging, everyone knows that as soon as oil prices do come back because of demand, there are going to be many, many countries saying it's been so difficult for us to cut back production levels, Nigeria included, to the amounts that were required by the OPEC plus production quotas. And there will be stresses in the system. So you raise a very interesting point for Joe. On the one hand, there is this unmet backlog of foreign exchange demand. On the other hand, it's not clear, apart from external borrowing, where you keep on deferring that commitment into the future, where you're going to be able to get the foreign exchange from to meet the backlog. And this raises the absolute necessity of Nigeria making sure it does everything to achieve a sound external rebalancing, increased exports.
How are you? Sorry, I missed your call. I was rushing to get onto a webinar.
Please mute your phone. Sorry, Razia, please continue. Pray continue.
I pretty much reached the end of my very, very long and lengthy explanation. Okay. So I hope that answers the question.
Yes, we've run out of time. I'm going to take just the last two questions, and one I'm going to just let you comment. You haven't spoken much about security or the political issues in this presentation. What's your outlook on that? The security issues may affect the budget and its implementation in 2021.
This is a very, very important point for Nigeria, as we all know. And unfortunately, what we've seen in Nigeria is perhaps a decade, if not longer, of rising levels of security threats. It speaks to the fact that even in the years when Nigeria was showing a healthy headline rate of growth, even in that pre-global financial crisis period, that the benefits of that growth were not necessarily evenly felt. And there were some places where not only were we seeing evidence that suggested absolute levels of poverty may have been rising, but perhaps much more dangerously, the subjective assessment, people feeling that they were actually worse off, also rising. And that just lends itself to a greater threat of insecurity. It lends itself to destabilizing actors being able to take advantage of that situation, and for the security issues to then spill over into a much bigger problem that causes issues for absolutely everyone. No one in the Nigerian economy is immune to this, even though the discontent and the perceived inequality may be originating in only parts of the economy and not parts of the economy that are pivotal to the generation of GDP. So if there's a lesson for this, and I spoke earlier about policy concerns that what we might be seeing on the back of the COVID crisis, the world over, is something of a K-shaped recovery. This should worry us all. We know that, there's been a lot of discussion. Economists spend an awful long time talking about this. What is the nature of the recovery going to be? Are we going to be seeing a U-shaped recovery, something like the global depression, where you stay at the bottom of the U for an extended period of time and it just takes a long, long time for the growth to come back? That is not our feel for now for the global economy for a number of reasons. First of all, when we look at the export numbers and the trade data, We already know that that China's economy will grow positively this year. In Asia, we are seeing good trade momentum. There has been rising demand for electronics from Asia as the rest of us move to work from home situations. And we're like, how do I get an additional screen for my home study? What else do I need? Well, all of that has fed into demand for electronics. Surprise, surprise, there's been a lift to activity. We also know that one of the key reasons for expecting that we're not going to be seeing a U-shaped recovery, it's not an extended period of time where so many people have lost their jobs and they have nothing to rely on, and you see something like a Great Depression again, is policy. The policy mistakes of the Great Depression are not being repeated. Everywhere we have seen monetary policy move to much more easier levels. We see it in a very dramatic fashion in Nigeria, but especially in developed economies. The scale of expansion of developed countries' balance sheets is far in excess of any expansion that we've seen in the past. They are pumping out record amounts of liquidity in the hope that this will improve. They're pumping out record amounts of liquidity in the hope that this will boost activity. And that's why we think we will see a recovery, a technical bounce. It may not quite be a V-shaped recovery, but a bounce at least in 2021. The real question, though, is, are we going to be leaving people behind? Is it the case that for those who are already comfortably well off, they will, they'll benefit from the kind of policies that have been put in place? And yes, they see a bit of a knocking back to their circumstances, but the growth comes back and they're in a better position. What about those people who are at the lowest income levels? What about the very real fact that in Africa, we're not just talking about what has happened to headline growth and the fact that in some instances we've reversed a decade of development, but we may have seen a reversal of development gains. Children out of school, girls' education, how quickly do they return to school? How much are we seeing a falling off in immunization levels because of the disruption caused by COVID? Very real development issues. And this is why we're all worried about the likelihood that we see slippage in important areas where there had previously been gains. If we see slippage in real development indicators, this lends itself to rising insecurity in the future. If we see rising inequality today, it's a social stability factor in the future. And as we all know, as economic participants, members of financial institutions working for large corporates in Nigeria, that this does have an impact on our bottom line. We can't just willingly wish away the insecurity and the risks that come about with this rising feeling of discontent. So it's been a long answer, Funsho, but that was a very important question. And my response to it would be, let's not just pay attention to the headline rates of growth, let's pay attention to the subjective experiences of how people feel about that growth. The recent protests that we had seen in Nigeria, how much of that was really also a reflection of the sense of there having been an entire lost decade of opportunity and the rising frustration that the economy isn't able to deliver more? The insecurity has implications for everyone, and policymakers will need to take that into account. I've now properly
Thank you very
taken
much,
up
Razia.
the time that we have.
I know we could go on forever, but really that people have said that the growth and recovery in Nigeria will largely be driven by how much made by largely countries like India, like China, like the US, and some of the European countries. How much of that do you think is within the control and scope of Nigeria to create its own internal growth without that growth being driven or led by what happens outside the shores of this country? That's on the one hand. The second point, and this is going to be the last point, has to do with the fact that countries get broke by virtue of the fact that they're basically spending more than they're earning. That's at the bottom line. World Bank, as a good monitoring tool. We've spoken on, but how much more do you think, and what areas do you think you can identify as pointers to Nigeria? It's revenue generation in Nigeria. Thank you.
Show, you were cutting out a little bit there, but what I got there was, how much can Nigeria rely on domestic growth? And the answer is Nigeria absolutely needs to raise the level of domestic demand. In the past, when oil prices collapsed in 2014, 2015, the policy choice was demand management. It was saying, let's try to keep demand at the right level for the exchange rate, and it costs the economy very significantly in terms of that demand repression. My advice as an economist would be, ultimately, the exchange rate does not matter, but real development gains do. So go for the boost to domestic demand. Try to keep it balanced. No one wants the instability that comes with, rising external imbalances necessarily, but don't focus too much on holding down domestic demand. Instead, allow the economy to grow, allow the productive sectors to grow, which is what policy is trying to achieve, to create that domestic demand. No country will ever be able to do that in isolation. We live in a globalized world. Nigeria will still be dependent on its oil earnings. It's not as though it can only boost domestic demand at the cost of what happens externally. But I think if there were a policy prescription, it's to say, do not hold back domestic growth. Try to let it reach its, natural pace. Look out for imbalances by all means, but this should never be seen simply as a question of the overheating of the domestic economy, which at this point, given very weak per capita incomes, it certainly isn't. The second question was, I think, around revenue collection and what can be done. And this is where there needs to be a much greater push towards greater formalization of the economy in every aspect. If you look at the revenue collection numbers for Nigeria, they are way lower than they would be in any comparable peer economies. As a percentage of GDP, there is vast scope for Nigeria to improve this. But it can't happen if you just look at the existing formal sector, what has been formalized already, and think this is going to be the answer to all of the revenue collection issues. Because there isn't the evidence that existing formal sector players necessarily, in a really big way, are not doing their bit to contribute to revenue. There needs to be a much more holistic approach which looks to bring the informal into the formal sector, to formalize much more rapidly, and then to go gradually, and hopefully the revenue gains will be there. I think the interesting aspect for me was that it may just be a function of Naira depreciation in the past, but the amount of non-oil revenue in trillions of Naira had increased significantly through to 2019. There was real evidence of something changing there. And the challenge for Nigeria is to bring back that momentum, but to address it in such a head-on way and in such a holistic way that it becomes the single most important factor. How do you formalize the economy? How do you get everyone contributing their little amount to raising revenue collection? In aggregate, across 200 million Nigerians, that will have to have an impact. And then all sorts of growth is possible.
Thank you very much. On that note, Razia, even if we wanted to continue this conversation further, I think the internet connectivity in Nigeria in Lagos at the current time is experiencing some difficulty. Zil just messaged me that his connection has slowed down as well. So it's a good time to wrap up the Q&A session and to hand over to Benedict, who will be giving the valedictory comments and vote of thanks. It's been wonderful speaking with you again today, and I'm sure I'll drop you a couple of
notes,
to share some. Thank you very much, Razia.
Before handing over to Benedict, I'd just like to thank everyone for their time and patience in listening, to say, do sign up to the research website. And of course, the ACT will make available this presentation pack to you. And I'd like to wish you all a lovely Christmas, a Happy New Year, All blessings for the new year, and I look forward to seeing you face to face as soon as the opportunity presents itself. So thank you, and over to you, Benedict.
Thank you very much, Razia. It was a very expository and insightful session. Okay, we'll call on Benedict, the treasurer of May and Becker PLC and a member of the Governing Council, to kindly give the vote of thanks.
Thank you very much, everyone. I hope you have all enjoyed the informative and interactive section on 2020 Economic Review and Outlook for 2021. I believe this interactive section could not have come at a better time. It is my honor and privilege to now give a vote of thanks. Firstly, I would like to thank specially the Governing Council of ACTN for putting this together. I also want to thank especially the panelists and participants. We cannot mention individual name at this point. I like to just say that you made this section very insightful. Razia Khan is so grateful, to have you share with us these deep thoughts and insights. Something that really struck me was when Razia mentioned that Nigeria is likely to miss out on substantive portfolio inflows, talking about foreign direct investment. She also did mention that Nigeria has shown improvement in non-oil revenue from 2017 to date, and that Nigeria has begun to take meaningful steps to clear the backlog of efforts. I would like to thank everyone that made this discussion a very educative and interactive one. Events like this, help ACTN as an association to foster the development of corporate treasurers on the buy side. And we say buy side, we mean the non-bank treasurers. Let me not forget at this point to especially thank the president of our association. Thank you for all that you do to ensure that we not only put up, good thought and discourse, but also to help our advocacy policies. Thank you everyone for taking the time to be here today and for listening to me speak. I'd like to say have a great day and compliment of the season.
Thank you everyone, and enjoy the rest of your day. Thanks a lot for being part of the ACTN webinar.
Thank you, Razia. Thank you, everyone.
Thank you. Have a good day.
You too.
Thank you.
You too. Bye.
Bye.